Hello, everyone. Thanks so much for joining us. And I just want everybody to get settled and situated, and then we'll begin the broadcast very shortly. I really appreciate you all for attending today on our last day of the Model Portfolio Review Week. And I hope you guys are keeping warm and ready for the frigid weekend ahead, especially if you're in the Midwest. And if you want to, feel free to use the questions section to let us know where you're tuning in. I love hearing where everybody is located and across the country. We got everybody from anywhere from California to Maine, so I love hearing it. So feel free to say hi and drop it in the chat.
Jenna is in the western suburbs of Chicago. I'm in the northwest suburbs of Chicago, and both of us have experienced a little bit of a snowstorm overnight. And I had my internet was out for a couple hours this morning, and my power was flickering. So hopefully, I've got some, I guess, some sticks rubbed together if we need to keep warm or something. I guess I don't know, but I guess if we lose power, we lose power. Hopefully, we won't.
Crossing my fingers. All right. Well, it's 2:03, so I'm going to begin. Hello and welcome to this afternoon's webinar, Invest Like a Legend, Stock Superstars Report Portfolio Annual Review, led by John Bajkowski. Thank you so much for joining us, and we're happy to have you all here. My name is Jenna Brashear, and I'll be your host for today. And a few things to go over before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And additionally, a copy of the slides used during today's presentation will be sent to all who attended. And if you have any questions for our speaker during the presentation, you can submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, I will select a few questions for John to answer. And questions that are not selected for the broadcast will be reviewed and addressed afterwards. And you can always send them to members@aaii.com or johnb@aaii.com. And that's on your screen right now, but we'll also have it at the end. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings, or you can go to the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available early next week on the Stock Superstars Report website, along with this link with this presentation's handouts and any resources that we discussed today. And we always like to give a little background about our new organization for new viewers. And so the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jenna. And again, I want to congratulate you for doing such a great job. We're so lucky to have you here. Jenna's been shepherding us all week, going through these various portfolio reviews. And hopefully the information has been consistent. And she's actually, I think we were chatting before our presentation today, and she really enjoyed seeing the questions that people pose. It gives her a lot of insight as to the interests and concerns of our members. And thank you so much for joining us as well today. It's a bit of a challenging presentation to put on, unlike the other webinar presentations we've done this week, where we focus on one given strategy. The Stock Superstars Report is actually a collection of 4 distinct strategies that all have their own buy and sell rules and their own strategies for making use of them. And today I'm going to spend most of my time giving a little bit of insight about each strategy. And the reason I want to do that is that, really, it's important to be comfortable with the approach, to believe in the approach, to understand what makes an approach do well and what kind of situations it doesn't do well in. Because no matter what, I've been doing investing for so many years now, we're always challenged. My first year, we had a big market crash, Black Friday, and it was a learning lesson for me. I mean, I learned that panicking is not a strategy. I learned that having a set of rules in place when you are going to be tested is very important. And so my goal today is to provide a little bit of an overview of the overall market last year, take a look at the performance of the Stock Superstars Report as a whole, and then kind of dive into the 4 different strategies, take a look at the holdings that are currently in there, how they performed this year, what kind of stocks are currently passing the strategies, and how everything kind of fits together. So I welcome any kind of questions that come your way. We're planning on taking a pause in between each strategy to give you a chance to ask questions about a given strategy. And with that, grab some coffee or tea or beverage of choice and listen along. So looking back last year, was an interesting year for the market. Get my slide to advance. I mean, quite a rebound from the year prior. 2022 was just a terrible year for the most part, double-digit declines across the board. Value typically held up better than growth last in the year 2022, but still, all in all, a relatively weak year. And 2023 actually started on a great trajectory. We had a broad participation in the marketplace. A lot of small caps were doing well. A lot of value stocks were doing well. And then we kind of came across the regional bank crisis, and that kind of put a damper on things. All of a sudden, a lot of uncertainty was in the place. The regional banks are so critical for a lot of smaller companies, so critical for the consumer, and as far as lending and whatnot. So it was a lot of there was concern perhaps that the Fed could not, prior to that, slow down the economy enough and slow down inflation enough. And in many ways, the regional banking crisis kind of did that for the market as far as slowing things down, but in a way that allowed the market to slow down, the economy to slow down, inflation to kind of cool off, but not in a way where we're anticipating any kind of economic downturn. But all in all, it was so looking back at the year, you know, small caps did very well until the regional banking crisis, and then it was the year of really the Magnificent Seven. Once the banking crisis was sort of being controlled, the big word, I guess, was artificial intelligence, large learning language, ChatGPT, and companies that were positioned to really take advantage of that. In your handout, and again, feel free to download the handout using the link on the website. I've got 67 slides. I don't think I'll be touching on all of them today, but I really enjoyed this particular next slide, which kind of this and the companion one next to it kind of gives a rundown on some of the big events that occurred last year, and just kind of gives you a sense for, as we had this relatively strong marketplace, and how the S&P itself was really the strong performer behind it. So it really generated much of the returns in the large cap area. Other thing to consider then, I guess, was what kind of sectors did well last year. And it's always risky when you are looking at sector performance to anticipate that's going to continue on for the next year. Obviously, information technology had great streaks in 2019 and 2020, but then 2022 was really one of the weakest performing approaches. In fact, the three of the four weakest performing strategies last year were the best performing strategies this year. And the only two approaches I think that had positive rates of return in 2022 had negative rates of return for 2023. So it's very, the momentum is an interesting approach, but it doesn't necessarily, if the market is in an area of turmoil and the economy is shifting, it is difficult to just simply project that what did well last year will continue to do well next year. The question you have to ask yourself, is the environment changing? Are the conditions that led that approach, that strategy, that sector to do well last year, will that hold true in the future? If so, it may make sense to continue investing in that. If it doesn't, then perhaps not. But this is important to look at because it helps kind of give us a sense on what drove returns today. So if you're investing in a given approach, what were the factors that helped push it? Large cap growth did really well last year. Small cap value, not so much. Information technology, communication services, consumer discretionary did well. Utilities with the change in interest rates did not. Energy prices fell. Energy, if you had a lot of energy stocks, you did poorly. And so for the most part, the more sensitive, economically sensitive sectors, industries did better last year. Some of the defensive ones did not so well last year. Which this is a chart that we had in the January issue of the SSR report, and it kind of gives us a breakdown of what are the best performing approaches last year and the weakest performing approaches last year. We'll be doing a look of each individual approach one by one, but really the economically sensitive, the home builders, Pulte Group, D.R. Horton, Warrior Met Coal, that's metallurgical coal. That's coal that's used to help make iron. Applied Materials Technology stock. Those were the winners last year. Those were the strongest performers. A lot of them bounced back from the year prior. Although Warrior Met Coal had 2 years in a row where it actually was one of the top performing stocks. In the weakest area, we had Zumex, which very much a kind of a clothing store for which can be quite fickle. We've found difficulty investing in hot clothing areas. Technoglass, it was a relatively short-term holding involved in technology, in kind of architectural glass used in buildings, and it just got caught in the wrong part of the market time, and we ended up, because of its approach in Group 1, ended up selling it as it was weakening up. Looking at the sectors that did well in the SSR portfolio last year, and it's a function of what we own, but really it was the basic materials, the consumer cyclicals that really helped drive the returns of the portfolio as a whole. Those are the winning areas. And while technology was the best performing large cap approach, technology didn't necessarily always go through against stocks beyond the Magnificent Seven. And healthcare actually did well, relative better than healthcare as a whole. And this gives you a sense for what were the factors driving the specific SSR portfolio. And I'll touch upon these group approaches, group performance in greater detail as we talk about each approach. But a couple of just quick highlights. So last year, the best performing approach happened to be the Group 3 O'Shaughnessy approach, which is more of a small cap value approach. The fact that it did so well, it's kind of interesting. It kind of broke the overall trend that was going on that area. But it is the riskiest approach as far as volatility. It's about 28% riskier or more volatile than the S&P 500. The least volatile approach that we track happens to be the Dreamin' approach, which is the large cap value contrarian approach. And the other ones are roughly in the same ballpark, about 120, as far as about 20% more risky as a group than the market as a whole. Now, one of the things when we are picking strategies for the stock superstars report is we look at approaches that have a good track record, but tend to move a little bit different than each other. And you could say in a broad way, growth versus value, but we also even look at standard deviation and the R-squareds, whether or not there's a lot of overlap in terms of direct movement. So the overall risk of each individual approach here varies from 1.28 or 28 times more volatile than the S&P 500. But when you combine them all, they roughly equate to the overall risk of the market as a whole. So as a group, as an overall portfolio, it's only about 3% or has been only about 3% more volatile than the market. So you can, I guess it's the evidence of diversification. By holding the 4 different approaches that tend to move a little bit differently than each other, you're able to hopefully gain some of that return and minimize the level of risk that you're taking on. So there's a diversification benefit that you gain by holding all 4 strategies. And I'll be touching upon, again, these individual strategies more, but long-term, going back from its inception, SSR is interesting because it combines 4 approaches, and we have rules in place that if a strategy happens to be underperforming and losing more holdings than others, we will go ahead and switch it out to a new approach. And we use our stock screens area as sort of as the feeder for that. But there are 2 approaches that we've had in our portfolio from inception, and that is the Group 1 O'Neill approach, as well as the Group 4 Neff approach. The Dreamin' approach actually was not too far off from our inception either. We ended up adding it in 2026. The group that we've always struggled with the most as far as having it fit in and having it perform well on a relative basis and on a risk-adjusted basis has been Group 3. And we've had anything, I think we had SWAG approach in there for a while. We had earnings estimates, price to sales. And only recently, in the last few years, have we settled upon the O'Shaughnessy approach. And that's actually done very, very well. And it's a little bit different than the rest. and it shows you the benefit of diversification. And all in all, most of the approaches, let's see here, we've been able to outperform the market as a whole, and the approaches themselves have done pretty well on a risk-adjusted basis as well. And that's sort of the key element that you want to take a look at. Um, Now, kind of highlighting how different strategies will zig and zag at different points in time. And I'll be showing these one by one against the overall portfolio. This is a chart that shows the relative performance of each strategy and the SSR portfolio as a whole over time. And when the line is going up, that means it's a period of time in which the portfolio itself is actually outperforming the S&P 500. When it's trending down, that's a period where the market is outperforming that strategy. So when you have a group 4, the blue line, the NEF approach, for example, you can see how it had a really strong run at the beginning, 2022, and I think I have a marker here. Let's see if this works. It had oops, sorry, did not work. Apologies to that. I thought I was going to be able to highlight something there, but did not work. So early on, first few years, you had that strong upward uptake on the NEF approach. And then it kind of did well, had a general upward trend. But then back in 2014 through 2017, underperformed the market and had a little bit of a run up. And then again, underperformed the market till about 2020. The opposite, has been on a relatively strong tear. And this purple line at the bottom, that happens to be group 3 approach. That is the transition. You can see how historically had initially, when it was the Zweig approach, did very well first 4 or 5 years, and then struggled as we tried to get the right strategy to fit in there. And only until 2020, when we switched over to the O'Shaughnessy, did you see that big relative outperformance against the market as a whole. So they all combine to form the red line in the middle. And our goal is to have 4 good strategies that work well independently and actually help as a whole outperform the market on a risk-adjusted basis. And what is a stock superstar? I mean, it's an investor that has a systematic approach to investing with outperforming the market over the long term. And when we look at our source for inspiration as a member of the AAII, we have these stock screens online, and we have a long history. In fact, I've been with the association now, since '87, I believe, '86 technically, actually, and it's from that time frame. We've always been looking at quantitative ways in which an individual investor can use to take a large collection of stocks and find a smaller set of stocks that meet their personal investment needs, interests, style. Years ago, I mean, we would be using Stock Pack 2 from S&P. You'd go ahead and perhaps pull up Value Line, the book, and it actually had in there screens or results of screens. And even when I remember designing the Graham enterprising screen and Graham defensive screens, those were written by Benjamin Graham when computers weren't that common, and he actually made use of a printed S&P stock guide, and he gave people kind of tips on how to go through there and what to look for, so you could quickly come across and call a big list of stocks down to another. So, it's important then to understand that when we're talking about these screens, and this is sort of what we look for. We're looking for screens that have good long-term performance on a risk-adjusted basis. Look for screens that work well together, kind of complement each other. But the important thing to consider as well is that when we have even a name associated with a guru or a stock screen, these are our interpretations of these approaches. So very often they'll come from their books, their teachings, their works. We'll go ahead and read a book and try to pull out the kind of quantitative rules that are expressed in there. Sometimes they're very explicit as far as what they look for. Sometimes you have to kind of interpret it, but often they'll give you the overall techniques, the approaches they use to find stocks, the approaches they use to go ahead and sell stocks, as well as the portfolio management rules. And that kind of which drives that. And this is the source of inspiration for our various screens in the SSR report. And again, we're taking the best from those stock screens. And again, it's our interpretation, and we're trying to diversify it across style and whatnot. It's typically when we, when we first started the stock superstars report, we actually tried to invest with 60 stocks. Now it proved to be a bit too much. For many years, it was 36, and lately it's been 40 when we actually went ahead and revealed the 4 approaches, specific screens behind each approach. And if you want to, probably one question we get, how do the stock superstars report screens differ from the ones that we have online or in Stock Investor Pro? And the genesis or the elements of those screens are often the same: the starting point, the qualifying lists. We do typically add some additional factors as far as making sure there's enough liquidity, exchange listing, share price minimums, but then also we go deeper into the sell part of it. With the Stock Superstars report, we're very focused on how to manage the portfolio from both a buy basis and a sell basis, because selling is often the most difficult thing to control, and yet it influences our rates of return so much over time. So that's kind of an overview on how we kind of came about. And I'm going to spend some time now going into the 4 different approaches. And I'm going to start off with the William O'Neill approach. And again, there are 4 distinct approaches. William O'Neill is, our focus here. He was a great stock picker, founder of Investors Business Daily. And I first heard about the approach called CanSlim at a seminar presentation, and it probably would have been in the 90s, I'm guessing. And it was a very interesting approach. It was the notion of how can one go ahead and find interesting stocks. And the key about the CanSlim approach and is that he himself was sort of a data scientist, data guru, and even developed Investors Business Daily because he couldn't find the information he wanted to in the various sources of information that was out there. And he looked at these winning stocks and tried to figure out what characteristics they had before they became winning stocks. And it formed this easy to remember, clever 7-letter acronym here. And so our Group 1 approach, and it has been doing so since the beginning, follows this CanSlim approach. So these are the characteristics that we look for stocks today, and these are the characteristics these stocks had in his experience before they went on to become big time winners. And it's primarily the one thing that's unique about the O'Neill approach versus the other approaches. There's no valuation elements to it. But one thing that we always look for, and one thing we screen for, are companies that have strong current quarter EPS figures. And these are, when we talk about quarterly earnings, you're talking about year-over-year changes in earnings. A stands for annual EPS. And if you just screen and it's commonly just try to screen for high levels of EPS growth, historical or future, and that's typically does not going to give you stocks that outperform the market. I think what makes the CanSlim approach unique and successful is that it requires consistency of earnings changes. It requires 4 or 5 years of year after year changes in earnings. It's going to knock out a lot of cyclical companies. It's going to only give you the stocks that are really able to perform well on a consistent basis, no matter what the market is. There's also a 25% annual growth rate requirement, but again, that's not as important, I think, as the year by year. And that historically has been the most stringent filter that has companies passing this particular filter. And then the other part that's kind of more of a qualitative screen than it is really a quantitative screen is N stands for new company, new product, new service, industry trend, or management. Some sort of catalyst. William O'Neill found that stocks that went on to perform well on a stock basis had some sort of story to drive that interest. I mean, this last year, what was that story? That story was artificial intelligence. The stocks that had some sort of connection, artificial intelligence, had some sort of leadership in that area. They went on to perform very well. So there has to be some story to kind of capture people's imagination on that. What we look for stocks that are hitting new highs or close to hitting new highs as far as our quantitative way of trying to capture that N part of it. So in the SLI, so supply and demand. Now in its original study, O'Neill found that most of the stocks that went on to become, these big, 1,000 point gainers or whatever, they actually had a relatively limited supply, so that any kind of news, any kind of activity, any kind of interest really caused their stock price to shoot up. We found that that's the one factor that we really can't keep in the screen. It tends to be nowadays too exclusive, and it doesn't give us enough interesting candidates. So we wouldn't have companies like Microsoft passing if that's the case. So that is the one thing we've kind of relaxed in our interpretation of the Cancelam approach. And leader or laggard, we're looking for stocks that are showing strong relative price strength. That coupled with they're near their 52-week highs, but they're also having good relative strength against other stocks, and minimum some level of institutional ownership. And this is not, it was probably a bigger deal back in the 80s and the 90s, but nowadays it's pretty common to find a relatively attractive level of institutions following a stock. The question is, are they championing the stock? That might not be the case, but minimum level of institutional sponsorship. And finally, Cancelam is unique for us because it actually has a market component. We only will add stocks to the portfolio if the market's in an uptrend, and that's so unique against the other strategies. And when it came to our actual online tracking of the Cancelam approach from our stock screens, we simply did it when no stocks passed the Cancelam approach, and that typically would happen when no stocks were near a 52-week high because the market was in a general downturn or economic situation, and there weren't companies that had positive earnings. But in addition to that, we actually look at things such as the 200-day moving average and elements like that to help determine if the market itself is in an uptrend. And only if the market's in an uptrend will we actually add stocks to the particular approach that we're looking at here. So that's the general element. And again, selling is very important, and Cancelam has the most stringent approaches, and we probably don't even follow it as closely as he would have, but we really look at relative strength, and you'll find that any kind of decline in earnings per share, any kind of decline in relative strength from high, and we sell off these stocks relatively quickly. It's created a lot of turnover last year, and it can be troublesome in kind of a market that's turning over and transitioning. And last year was one of those years where we actually had some stocks that were added and then quickly sold because the market environment at the beginning of the year was much different than the market environment at the end of the year. But that is, it's important to follow the approach when you can. And these are the current holdings of the Group 1 approach. And this happens to be sorted by their 52-week price as a percent of 52-week high. And Fair Isaacs, which was just added a couple of months ago, again, your FICO score is one of their critical things. But they've actually done quite well. And again, it's Elf Beauty, same thing. These are Microsoft benefited from AI and probably destined to become perhaps bigger than Apple in the near terms for our largest company in the country. So you're going to find here stocks that are typically pretty expensive on a price earnings basis, but they will have the growth. And if we see any kind of downturn, continued downturn in year-over-year earnings, that'll be a sell signal on the fundamental side. But more likely, it'll be sold because the relative price strength is weak. As far as the top performers last year, this are all the stocks that were held in the group approach last year, and Microsoft was the biggest performing stock on a profit and ROI basis. Elf Beauty was number 2, and UFP Technologies number 3. And those are all stocks that had 40 plus rates of return. But then we also had a lot of losers, and Allegro Microsystems, a semiconductor stock. Now, if you see a starting value of 0 in that column, that means that the stock was not owned at the beginning of the year. If you see an ending value of 0, that means it was sold over the course of the year. So you could tell there was quite a bit of turnover in this approach over the last year. But as a whole, had great return, has some great owner securities, has some great ideas. And the other important thing to consider too, I know people are sometimes leery of buying a stock that's been in the portfolio for a while. But I think, you never know what's going to turn hot. I mean, Microsoft's been in there for a while, and it's had a great run recently. Fair Isaacs is new, and it's doing quite well. But anything that we have in, especially the Group 1 approach, anything in there is a candidate to consider for purchase. It should be very, it's going to be having good relative strength, earnings growth, and whatnot. But if you are looking for ideas, if you're looking for some new ideas, we do have this portfolio watch list on our website. And these are the stocks that are passing currently. Not too many stocks are passing the approach. In fact, a couple of them are held in the portfolio currently. Deckers, Tradewinds, and it's interesting, Euro Seas, you have a logistics freight company, and they were struggling, but then all of a sudden last year, most recently, unfortunately, because of some of the fighting going on in the Middle East, all of a sudden shipping rates have gone up because it's just the Suez Canal is no longer a viable method for shipping goods, and even the Panama Canal is struggling with having low water levels. So all of a sudden, shipping stocks did very well during the pandemic, and a little bit of shortage of equipment is out there, probably due to come online, but right now they're having a little bit of a resurgence. But if you're looking for ideas, we have every ideas here for every approach, and you can go ahead and sort them based upon the factors that are relevant for that particular approach. This is a chart that shows simply the relative strength of the Group 1 approach versus the SSR portfolio as a whole. And again, it's had its ups and downs. Anytime it's trending up, such as between 2009 and 2017, that would be a strong period of outperformance. Underperformed, really, going into the pandemic, bounced back very strongly and has been sort of suffering last few years. But all in all, from its inception, it's had a great outperformance relative to the market as a whole, and it's contributed to the overall stock superstars performance as a whole. That's a quick rundown on Group 1. Jenna, before I continue on, are there any questions that you might want to throw the floor open to?
Yeah, just a couple. Let's see. You actually recently mentioned the portfolio watch list. So we had a question that asks, do you pull directly from the O'Neill portfolio watch list when a stock doesn't qualify for the portfolio holdings?
Yeah, but that's our source. In fact, I update this normally weekly, every Friday. I looked at it today, and no new stocks passed, and none of these came off the list. So any stocks that we add for any of our portfolios come off the watch list.
Makes sense. And you also mentioned the O'Neill CanSlim stock screen earlier. And so an attendee was asking, do you recommend following the O'Neill CanSlim or a similar stock screen versus the portfolio? Or are there any apparent pros and cons of choosing one or the other? Or should you be actually looking at both of them and making your own decisions from kind of both strategies?
Yeah. I believe that we are closest to the third edition as far as we have a couple of different versions of the O'Neill CanSlim screen on our website. The only difference is that if you follow the screen online, will only give you the buy ideas. So you're certainly, it's a good way to follow it. If you want to follow it, just go ahead and use that screen. You have to then simply follow the cells on your own. So you have to keep a note of how they're doing on a relative strength basis or whatever factors you determine to sell. That's the one, I guess, negative element of the stock screens themselves, is that they're giving you more of the ideas, and really you need also the second part of that, which is the sell part of that. That's the one advantage that you get with the Stock Superstars report. We happen to help remind you, or help you track that information, and to teach you how to do that.
That is very helpful and good to know. And I think the last question I had that I saw was, and you may touch on this later on in the presentation, so I don't want to get too ahead of ourselves. But if let's say like the O'Neill isn't doing well at a certain part of the of the year or something like that, or maybe even one year it's doing well, and then the following year it's not doing as well as they thought. So should you switch to another guru strategy like very quickly, or should you ride it out and wait? How do you handle if one strategy is doing really well and then the other
Yeah,
is kind of lagging behind?
I wish I could give someone that formula. It would be wonderful if you could. Too often, it's like the challenge is too often you don't know that it's really lagging until too far after the fact. Uh, if you have again, but there are trending systems you could use. I have not done any studies that would help reveal if there's a method or a system that you could use to find out which strategy is going to do well. Um, you know, versus it's easy to look back and tell you which ones have done well. And it's even funny looking at some of the stock that passed these approaches. I mean, sometimes I know, especially with the O'Shaughnessy Group 3, it's like these don't look like the kind of stocks that a high quality blue chip investor would want, but the approach is done well because there's enough of them. So it's a challenge to know in advance which one's going to do best. I wish there was a system, but if someone has one, drop it in the comments and we'll see. We'll go ahead and test it.
Exactly. Well, thank you so much for answering, and I will let you continue.
Thank you. So the next approach is our David Dreaman approach, and David Dreaman, really a contrarian investor, helped really uh, make behavioral finance a active and positive thing. And our inspiration for the Dreaman screen was a couple of books. Probably Dreaman with a Twist was really the biggest inspiration for developing the current screen we use for the Group 2 approach. And even it spoke at and for some of our national meetings over the years. But I enjoyed reading his work, and it was very, very helpful. And again, he was a contrarian in nature, and he looked for stocks that were perhaps a little bit out of favor, but were typically larger, so they had the resources to bounce back. And he would, prefer for them to be paying some sort of dividend, so they had the financial strength behind them, and a number of qualifying factors as well. So these were stocks that were out of favor, not the cheapest of stocks, because he didn't believe often the stocks that had the lowest PEs deserve to have those PEs, but just below average as far as market valuation, but having the characteristics that made them attractive to be potentially mispriced. And one of the things he really talked about a lot, I remember in his last book, uh, and was the whole notion of how earnings surprises are different for low PE stocks versus high PE stocks. And again, uh, earnings surprises, revisions, they're only surprises if the market truly didn't expect that to happen. And too often, if you're a high PE stock, um, the market anticipates that you're going to beat earnings, you're going to keep growing, you're going to do better than expected. But if you're a low PE stock, often if you have negative news, if you're a high PE stock, the market punishes you. If you're a low PE stock, often any kind of positive news is just kind of a nice surprise, and negative news is shrugged off, and the market doesn't react negatively from a negative earnings surprise. So really, these kind of forecasting errors, which are common, such that we have an earnings surprise element revision part to the screen. He found that low PE stocks with positive earnings surprise, positive earnings revision was a very good profitable combination. So when it comes to the Dreaman approach that we are following, again, he wants mid to larger companies with the financial resources and the visibility. So if they all of a sudden if they're troubled and they bounce back, the market's going to jump on them. And not the lowest PE, but PE below the overall level, and have a reasonable dividend yield, visible earnings, good financial strength, good ratios, and all the rules are available on our website. But that kind of gives you a sense for what this contrarian approach is. When it comes to selling, again, the rules that we use to buy the stocks or add stocks to Group 2 are kind of the ones that drive what to sell. So in this case, with the Dreaman approach, once that PE, looking for stocks that have a discount PE to the market. Once that PE becomes a premium, 1.5, we go ahead and figure maybe a good company for a growth portfolio doesn't make sense for the contrarian portfolio. If the multiples are exceeding the sector industry, if the price performance is poor. By price performance, we mean we look at relative strength, especially if we've held it for a couple of years, 2 years, 3 years, and the stock is just simply not panned out. Maybe it's time to move on and go ahead and find some other candidate that's still passing. We just did that this past year, this past month actually, with one of our holdings. So again, it's larger cap stocks, dividend paying, lower PE, good financial strength. Those are the drivers for adding stocks, and then also the drivers for selling stocks in the Group 2. And as far as the current holdings, they happen to have, in fact, one of the stocks in there, I think, reported today, JP Morgan Chase, and was one of the better performing stocks in the portfolio last year, one of the better performing big banks last year. But what you see here are larger companies, more stable. They're all paying a dividend. And the factors here, such as you can take a look at the market cap, and these happens to be ranked by the PE ratio with the, strike that, they're not ranked by PE ratio. Meant to rank it by PE ratio. They are by PE ratio, but actually they're highest to lowest. I would have probably done it the opposite. Apologies on that. So the most expensive stocks are at the top, and the cheapest stocks, except for WestRock, which has negative earnings, trailing earnings, is at the bottom. So this happens to be, in this case, Evercore would not quite a sell year, but sell here yet. But this is the type of stock that is getting close to being kind of potentially sold because of its PE ratio, whereas the stocks in the bottom, even JP Morgan, this good run up last year, is still in the attractive range as far as PE is concerned. We're not looking for the cheapest PE, but at least the cheap PE like below 40th percentile, and looking for some reasonable earnings. I'm seeing Evercore has some revisions downward, which is kind of a negative thing, and attractive levels of debt to assets against the industry norm. These are kind of factors we consider, and the best performing stocks last year. Now, just as a quick note here, Knife River, which is on the list here, was held less than 10 days. That was a spinoff from MDU Resources. So that was kind of a utility that we have, and the utility is sort of spinning off, and it has intentions to get rid of spin off all of these non-utility type businesses over the course of the next year or two. So that actually was our starting value of 7,400. We ended the year at 4,800. But then also we realized we didn't adjust this properly. We realized also a $2,330 gain from the spinoff of that particular security. So Evercore was the best performing stock last year. And the difference between profit and return on investment would be the amount of dividend that comes into play over the course of the year. So these are, again, dividend paying stocks. You should see a little bit higher level of return on investment versus profit. But all in all, I mean, the winners did much better than the losers in this particular portfolio, and did pretty well. Some interesting ideas in here. And again, with the exception of a couple of stocks, and when we do our monthly issue, we always talk about the deletion watch list. So if you're a subscriber, please take a look at that particular section. Any stocks that are on our watch list or we're keeping an eye on because they're getting expensive or something else is happening, we mentioned there. If you're looking for ideas, it's funny, only 4 stocks are currently passing. And some of these actually has started, some of these passed back in September of last year. Most recently, Primerica passed. It's not part of the portfolio. So relatively small number of companies are passing right now in the Group 2 approach. And that's kind of interesting. But this would be, again, if it comes time to sell anything, this is where we're going to go to as far as buying something greedy and also part of the portfolio. So only 2 stocks here are currently not in the portfolio that are passing the watch list. As far as performance is concerned, it's interesting. It's had its when you would thought it would have done better in the whole value era, the 2000s, but it actually struggled a little bit in that value era and did really well post financial crisis, and struggle again back in 2017 and on. Picked up pretty strongly back in 2022 on a relative basis. And then interesting approach. So it's a little bit not as strong as the SSR approach as a whole, but there are some interesting ideas in there and some good stocks in there. So that's, again, it's diversification element that comes with it. Jenna, any questions about David Dreeman before you move on?
Let's see. I think you can move on. I've asked people to feel free to submit their questions. I don't see any yet. A lot about the overall portfolio, but I'll leave those to the end.
Very good. And group number 3 is James O'Shaughnessy. And again, we've got a lot of O'Shaughnessy streams on our website. And part of it is because he's written many books over the years. His, What Works on Wall Street series has really kind of interesting because it's changed quite a bit over time. The approach itself has changed that he's talking about. Initially, was a very simple approach that looked at things like price to sales and relative strength to form a cornerstone growth versus a cornerstone value approach. But as he came out with new editions of his works, he came out with more sophisticated techniques that really went into that. And he really was strong into factor investing, but he went from doing really single factor to doing multiple factor. And when a couple years ago he helped write an article for the journal, and he helped us develop a kind of a value metric that we use as far as looking at how to value a stock. And there are factors that go into that. And, the whole premise behind the O'Shaughnessy stuff is that, by taking a look at how stocks rate in certain areas, and you're much better off taking a look at a combination of factors and taking a look at things such as price to sales, price to book, enterprise value. And if you take it at an individual component, I think I may have a chart here. I apologize, I don't. Okay, sorry. If you have an individual component, it might do very well one year, but might do poorly the next year. So you're going to probably have identify some really good winners with one particular approach, say price to sales, but it'll do well one year, but not the next. If you create a composite of all of these factors, you might not get those extreme big hits, might not get the grand slams, but you'll get a lot of doubles and triples. And the composite kind of you're giving up a little bit of the potential identification of some of the really big outlier companies, but you're getting a more consistent level of companies that tend to perform well. And the value composite we use for the O'Shaughnessy approach is the same one that we use for A+ investors. We kind of develop the two at the same time. So if you like the value composite, if you like the O'Shaughnessy approach, the value composite that we use, the O'Shaughnessy screen that we use on A+ investor as well. The additional elements that we found is that, really quality, if you're talking about value, it makes sense to have some quality scores because many of the cheaper stocks are cheap for a reason. So having some quality to it helps to make sure that they actually don't deserve to have that low price and they're going to bounce back. And also earnings quality as well. We want to take a look at companies that have there are some additional factors behind that earnings so that you have positive cash flow, not just simply fake earnings or earnings that are manipulated. So you look at things that are really like which are called accruals, operating assets, total assets. You're looking at really making sure there's underpinning strength behind the quality of earnings. And the same is true of financial strength. So the O'Shaughnessy screen combines our value measures. It looks for stocks that are the cheapest, A grade type stocks, and then we sell them when they fall into the most expensive area. So right now, the stock that and it's funny, the stocks that are passing the O'Shaughnessy screen are at least lately, at least the last 2 years, often they tend to be smaller. Very often they're names you've never heard of. Right now, we have a number of companies that are in the shipping area in here. I think we have 2 in the portfolio right now. In fact, I just got news. One of our holdings here, Pathway, DNOW, strike that. Now is going to be changing its ticker symbol. Strike that. It's taking on its ticker symbol in the course of the next month or so. So now company will become DNOW shortly, one of our holdings. But the approach itself has done very well. It's been very volatile. A lot of volatility here. You're not going to find many stocks that pay dividends here, but they're cheap, and this happens to be ranked by value score. The most expensive stock in the group right now is Gentex. So if this value score drops below 20, it would be a sell. And also we take a look at overall relative strength from high. If we held it for a long time and it's no longer performing well, we'd also sell it as an overall basis. Best performing stock last year, 2 years in a row, was Warrior Met Coal. Universal Insurance also did well, and Algoma Steel Group as well. So interesting that the industrials really did well. The mining companies, shipping companies did well. Poorest performing stocks, we had this retailer, Zumez, um, consumer lending company, Curio Corp, and Bank of America, which got kind of caught, unfortunately, on a relative strength basis during the financial crisis early last year. Probably has bounced back since then. But we had strict sell rules as far as that was concerned, so we ended up selling the portfolio out of our portfolio. But these are the winners and losers of the Group 3 approach last year. And on the watch list side, interesting companies passing here. The challenge, with this is again, this is our starting point for adding stocks to the portfolio. The challenge with is sometimes you have to do some little bit deeper dive. I think like some of these companies, this Dago New Energy Corp, I think it's based in China, if I'm not mistaken. And we typically that would be kind of a qualitative rule. We don't often invest in companies that are domiciled in China or Russia. It's nothing. I don't want to say anything negative, but it's tough to invest in a country where all of a sudden, at one point in time, your property could be taken away from you, and how well can you actually do they follow all the necessary accounting elements that we want to keep track of? So plenty of opportunities exist domestically. So there's often no reason necessarily to invest in countries such as China or Russia. But iHeart Media, I think that is closely controlled by the family. A couple of these have share prices below $4. Normally speaking, we would not invest in a company or add a company to the portfolio that has a stock price below 4. It gets into the penny stock region. You may think otherwise, but those are some of the factors that make it more difficult for us to buy stocks or pick stocks from the Group 3 approach. And now historically, the Group 3 approach sort of struggled. It's had runs, but it's typically underperformed and has been net negative to that of our SSR portfolio. But if you go up to 2020, this is when we switched over to the O'Shaughnessy approach. I mean, ever since then, it's actually done really strongly on a relative basis. It's really had a big boost to the performance, and it's been one of the best performing approaches since we've switched over to the O'Shaughnessy approach. Any questions before we move on to Neff? If not, that's
Yeah,
fine.
yeah, we got two questions that are specifically about O'Shaughnessy's the Group 3. One of them saying, asking basically that they've been following the O'Shaughnessy Tiny Titans for years, and if you just take a look at this at the stock screen page, obviously very surprising. It's done extremely well over the last several years. Do you think there's anything really specific about this strategy that makes it perform so well, even compared to other O'Shaughnessy strategies and stock screens?
Yeah, O'Shaughnessy Tiny Titans is sort of interesting. You're right; it does have a very strong performance. Its focus is strictly price to sales. It's small cap. I don't recall if it has a relative strength in there as well. It is funny because personally, when it comes to price to sales ratios, it has simply, I think, looking for low price to sales. I personally prefer when using price to sales to compare it against a company's own historic norm or against companies in the same industry. It does not, but it's been doing well. But it is a single factor, and I think that kind of highlights the discussion we had previously about investing in a single factor uh, element such as price of sales versus a composite screen. So Tiny Titans is going to have these hot runs. Often it'll be based upon a small number of companies, and unfortunately, which is how you get those big runs is by not being necessarily diversified. But it's a kind of a derivative of the old cornerstone value approach. Again, if you're looking for the big home run stocks, some ideas, it's a great source for that. If you're looking for stocks that have a wider array of positive characteristics, the composite score will be a better way to go.
That makes sense. And the only other question we had for specifically O'Shaughnessy was how is portfolio turnover for Group 3 O'Shaughnessy compared to the other strategies and groups?
The O'Shaughnessy actually was relatively low. The highest portfolio turnover is in Group 1. but the Shaughnessy one has been relatively low as far as turnover is concerned. It takes a while for the stocks to move from ultra cheap to ultra expensive. And so we buy them when they're super cheap, we sell them when they're super expensive, or when the financials are deteriorating. So turnover has not been that great.
Excellent. Excellent. Well, I'll let you continue. Thanks, John.
Yeah, in fact, I think perhaps the only turnover might have been from oh, never mind, that was another group, sorry. So John Neff, that's sort of another one of the approaches that has been um, with the portfolio since the beginning. And he was a longtime manager of Vanguard Windsor Fund, back when Vanguard was actually involved with many actively managed funds, not so much index funds that they are now. And he had a great track record. And he wrote a book that served as our inspiration for the screen. And he kind of wrote it during the growth era of the 1990s. He kind of frustrated with the lack of emphasis people were putting on good fundamental analysis. And the basic premise of it is that we're looking for stocks that are priced relatively attractively, not the cheapest, and they have good growth, but not the highest level of growth, minimum 7, but no growth not greater than 20. Attractive sales growth, again, high minimum, at least 7% annually, but no higher than 20. Positive cash flow. And the fundamental rule that we use for the NEF screen is the PEG ratio, which divides the price earnings ratio and relates it to earnings growth and relates it to the dividend yield. So a company can have a higher price earnings ratio, can support a higher price earnings ratio if its growth is higher. So there's nothing wrong with having a little bit higher PE ratio if the growth is there to support it. And on top of that, why penalize the stock if it's paying a dividend? So if you simply take that price earnings ratio and divide it by the growth and add to that growth the dividend, you get a PEG ratio. Lower the PEG ratio, the more attractive the stock. We have a couple quick examples here. So if a stock has a PEG ratio, a PE of 10, earnings growth of 5, it's going to have a PEG ratio of 2. Another stock trading with a 10 PE ratio, but happens to have earning growth of 10, has a PEG ratio of 1. That second stock is much more attractive than the first stock. And then you go one step further. You have a PE ratio of 10, a growth rate of 10, and a 5% dividend yield. All of a sudden, your PEG ratio is down to 0.67. So we look for stocks in this portfolio that have a PEG ratio half of that of the market, and we sell them when they get to above that market. So these are that's the primary factor we use to buy stocks for this portfolio. So again, looking for growth, 7% a year, but not higher than 20. And again, low PE stocks with a good yield, again, a little bit of a fundamental element, a little bit of financial strength to it, and good financial support, cash flow. Look beyond earnings. So you want to support that earning, but you want to make sure the sales is there, make sure the cash flow is there, operating margins, it has some competitive advantage against the industry norm. And when it comes to selling, if the fundamentals have deteriorated, if the price has met our goal, again, make you a mistake. If you've held the stock for a couple of years and it's longer, it seems to be going down, or if its price relative strength from high is declining, go ahead and sell it. So again, it's quick quote here: when you feel like bragging about a stock, it might be time to sell it. But all in all, it's the opposite of why we buy them. So on the NEF thing, it's when that PEG ratio gets to be too high or the fundamentals are deteriorating and pushing that PEG ratio out of norm. That can happen as well. As far as the current holdings, this happens to be ranked by PEG ratio, although it's interesting that Pulte Group just this past month had the PEG ratio go to NMF because the consensus earnings estimate went away for that particular company. So you have bits of information here. The PEG ratio is a dividend adjusted EPS growth, the historical 5-year sales growth, estimated future EPS figure. So the estimated EPS for Pulte Group went away, and right now we have a NA for the PEG ratio. We'll have to go ahead and calculate some sort of derivative on that, taking a look at the year-by-year projected growth rates and earnings per share. How the operating margin compares against the industry norm. Those are factors that perhaps point out to some sort of industry relative competitive advantage of some sort. Best performing stocks. Again, we have another stock that had a spinoff. In this case, Borg Warner had a spinoff of a company last year, helped, in that case, with its rate of return. And outside of that, Pulte Group, the home builders, just had tremendous performance last year. You had the situation where with high mortgage rates, I know Jenna's looking for a home and is struggling to find homes to buy. With the sudden increase in mortgage rates, people were locked into their homes. They couldn't afford to sell their home and buy something new. So all of a sudden, the existing home market dried up, and the people who benefited the most were the home builders themselves, because people who wanted to buy a house had to turn to them to get a house. And they were able to also work, in some cases, incentives to make the mortgage rates a little more attractive. Those are the big winners last year. And on the ideas list, this actually normally has this is the one that typically has the greatest number of ideas of our current group, and a wide variety. I mean, PayPal is in here. Got Hibbert, which I think is in other portfolios we have at the AAII, Shutterstock. Interesting collection of companies that are passing this screen. So some good ideas here. The approach itself, the red line is the SSR, and the blue line is NEF. And again, it's from the beginning. It was a very strong performer from the beginning. It's had a period of, again, a lot of value underperformed back in the last 10 years or so. But this approach itself, since 2020, has been strong on a relative strength basis, and a lot of good candidates have come out of there. That's kind of a bit overall rundown on the overall SSR portfolio, and I wanted to leave some time for questions. And with that, Jenna, I open the floor to questions, and we'll hopefully shine some light on things you might have.
Definitely. Well, we had one specifically for NEF, so I'll ask that one first. So obviously, you mentioned that one of the main factors of the NEF strategy is the PEG ratio. So someone asked, are there any downsides that one who is following the NEF strategy, should be aware of or keep an eye on, because it's very heavily weighted on looking at the PEG ratio?
Well, the nice thing about the NEF strategy and the PEG ratio is that, especially on the buy side, we make sure that the earnings growth is not too extreme, because if you look at studies that involve the PEG ratio, the studies involving PEG find that there is a relationship where the lower the PEG ratio, the better the future performance, except for the companies that have the absolute lowest PEG ratio. And often they have that super low PEG ratio because there's oddity to the earnings growth, or there's an oddity to the PE ratio. So yes, what you want to make sure is that nothing is out of the norm. You want to make sure that if you're looking at the PEG ratio, that the PE isn't unusually low for some reason because of a one-time event. You want to make sure that earnings are not too high in an unsustainable way. So those are the two factors you want to make sure, that those things aren't pushing that PEG ratio to some bizarre low level.
That makes sense. And let's see, we had a couple of questions. So that was it on the NEF, on just the specifically NEF, but we had quite a few questions come in, and please feel free to continue to submit questions as we go. But so I guess one of the first questions that came through was, if you just signed up for SSR, a couple days ago, how would a new investor determine which portfolio is best for them? So when you first log in, you obviously see a variety. You see, 4 different groups plus the SSR. So what factors should they consider if they're just beginning?
If you're just beginning and you want to get comfortable, you could always start building a paper portfolio before you actually commit money on your own. But I would normally, I would try to get 4 or 5 stocks from each approach, and I would look at the factors that are driving the purchase decisions in each screen. So you might, in group 1, you probably would look at, perhaps the relative strength from high stocks that are hitting new highs. In group 2, you would consider perhaps the PE ratio, looking at stocks that have lower PE ratios. In group 3, you probably would focus in on the stocks that have the lowest value score. And in group 4, you focus in on stocks that have the lowest PEG ratio. So if you're not going to pick them all, one way to do it is to look at the primary factor that determines which company passed a given screen.
That makes sense. And let's see, got quite a few. Actually, I'll ask this just because you have the table or the chart on the screen right now. But actually, quite a few people said they may have missed this. But could you explain what the y-axis specifically
Sure.
represents on the relative performance? Because I know a lot of people were delving into that.
Yeah, so this is showing performance relative to that of the S&P 500. So anytime the line is going up, that means for that past time period, that particular portfolio outperformed the S&P by a certain level. So if zero, anything above zero means that cumulatively the approach has outperformed the S&P 500. If it was below zero, I think we had that in some of these, that means for that time period, the approach from inception would have unperformed that of the market. So in this case, zero is here. So we see that initially, this happens to be the NEF approach. Initially, NEF did really well, and then it struggled really strongly in 2006, and then actually went below zero for a good 15 years, and then all of a sudden it bounced back up. So anytime the indicator or the line is going up, it means that that strategy is outperforming the market. When the line is going down, it means that for that point in time, the market it's underperforming the market. So if you came in, and in 2020, you would have lived to see basically performance from 2020 to the current point in time. It would have had upward trajectory over that time period.
See, and we got a couple more questions actually specifically about the NEF strategy. So I know one of our attendees noticed that the NEF strategy is heavily weighted to cyclical stocks. So in regards to just the NEF strategy, but also the other portfolios as a whole, how do you manage the diversification of different sectors or industries?
That's a good question, and it's funny because we don't. When we first ran the SSR portfolio, we were much more cognizant about industry concentrations, but we've been less so lately. We've kind of let the approach, the stocks passing the approach, kind of dictate what we put in there. We probably, we will definitely, if we start to see too many financials in a given approach, we'll ignore it and we'll try to pass up those financials. But we don't necessarily, within a given strategy, try to limit or create a portfolio that's diversified by industry or sector. As an overall portfolio, it tends to fall out that way, but we don't, on a given approach, look to diversify by sector or industry. But obviously, something you can do if you wanted to work off the ideas list would be to do that kind of diversification.
That makes sense. And you mentioned a couple times, if about looking at financial statements. So I did want to ask, how much do you take into account looking and analyzing financial statements like the 10K or other documents into decision making for the SSR portfolio?
With SSR, it tends to be based more on probably the derived metrics. We the factors we talked about, it's really, it is a bottom-up approach. You probably could add value by going through and doing a deeper dive. We will look for things like multiple share classes, restatements, things that don't make a lot of sense, but we kind of let the quantitative model, the simple quantitative model, kind of drive the decisions. So I probably go through the 10K looking at more some of the discussion points, the risks, see if there's any see if there's any customers that are disproportionate part of sales, any kind of risk factors like that. Look for any kind of share class issues that might come into play. So we look at those information. We look at the earnings presentations as well. So we review all that stuff on a regular basis, but for the most part, the quantitative rules drive the model. And I guess by owning 40 stocks, it helps the risk of any one stock perhaps torpedoing the portfolio. But it also, I guess, then on the flip side, one stock can't make the return of the portfolio shoot up great either.
It's true. It's true. And we had someone ask, so how does AAII as a whole, or just as far as the SSR, handle mergers and acquisitions when it comes to various portfolio holdings? A few people in the comments mentioned very specific ones that they were, but I thought that asking about how we handle the
Sure.
mergers and acquisitions, I think would give a good answer.
Yeah, well, if a company is being bought out and it's an outright buyout, and if the price reflects, um, largely reflects what the buyout will be, we'll just go ahead and sell it. The challenge is more so on if a company is merging or if it's divesting, and how does that change the overall financial function and the situation of that company? West Rock, merging or being bought out. Will its fundamentals still be true? Will it still be hold true to the approach? I think is the question. So are the factors that led to that particular inclusion to the portfolio, will they still hold true after this particular buyout? Those are the factors that come into play. I mean, sort of the how does the pro forma statements that often come out, how will that look like afterwards? Will it still be um, in style or in keeping with the strategy?
Yeah, let me see if there's anything else. Well, while we're waiting, I do like to always ask, this week I've asked, pretty much every analyst, was there anything that surprised you last year regarding the SSR portfolio or any of the holdings specifically?
Um, it's a good question. As far as, I mean, last year itself was a bit of a surprise in the sense that it started off on such a strong footing. And, we were concerned about the Fed being able to tamp down inflation. It kept tightening, but it didn't seem to be slowing inflation down much. And then we had all of a sudden the kind of the anytime you start playing with interest rates, it takes a while for that impact to be felt in the economy. And all of a sudden you had the regional banks starting to suffer. And I mean that kind of seemed to slow the economy down in a way that the Fed could not, and kind of reestablished the leadership in the marketplace. So for me, it was coming off of a really negative year, 2023. You had kind of the start of a normal bull market with broad participation, and for the longest time, it was just a very, very narrow group of companies participating in the market. And only in the last few months did we actually start to have the everything rally, where a lot of the investors went beyond just a few handful of stocks that were doing well, the Magnificent Seven. So for me, it was the average stock last year probably was only up about 7%. The S&P itself was up, 23%. So that tells you that the was not a broad participation in the marketplace, which
That
means that
makes
there's
sense.
attractive opportunities. It's probably more of a stock pickers market going forward.
Yeah. And oh, we got a very very important question. For those who have attended all week, will they receive a gold star? A trophy? Anything specific?
I might have some pins, AAI pins at home at the office. If you drop me
Oh, there we
drop
go.
me an email.
I'll tell them to email members at aaii.com and we'll see what we can get. No, thank you for attending. Everybody
Yeah,
who
thank you.
was an AAI Platinum or took advantage of our our trials. Yeah, thank you so much for attending this week. And let's see. I think I'll just pick one more question. There's quite a few. So like we said, if there's anything any other questions that we didn't answer and you would like to have answered or need some more specific analysis on, please email members at aai.com or johnb@aai.com. Let's see if there's anything. I missed this one. Actually, a couple members had asked, how is the SSR portfolio weighted, and how is that decided upon, and is that similar to the other strategies, or how does that differ?
Yeah, we always start off with equal market cap weighting. So we try to invest equal dollar amounts across all the holdings, and we also then so that um, if a stock starts to become too large a position in the portfolio, if it's 2.5 times the average desired position size, we'll sell off a part of that and reinvest it in underweighted stocks. So we kind of let the winners run a little bit, but then we have a limit as far as we take some profits if they become too large. So we try to invest equal dollar amounts in the portfolio. So within everything, these are now 10 stocks. Our goal is to have 10 stocks per portfolio. Group one only has 8, but we basically would take the overall dollar amount of that particular portfolio divided by 10, and that's how much we're going to want to invest in that particular position. So we then take that dollar amount divided by the share price, and that tells us approximately how many shares to go ahead and buy.
That makes sense. Thank you for clarifying. I appreciate that. And actually, there is one more question I saw that popped up. So on a like a Monday morning, do you have a favorite news source, or what do you turn to follow the markets? Is there anything specific or any resources that you use to make your decisions?
Yeah, it's a fair question. I probably it's rotated over the years. I mean, it's funny. I mean, I do enjoy Squawk Box in the morning and CNBC. Um, obviously their focus is a bit more on near term things that are going on in the marketplace. But I guess I just Wall Street Journal, you read that, you get and uh, I briefing.com is helpful, and it's funny, but actually often for news, I'll within the stock superstars report, if you click on a ticker, it brings up the quote media page. I'll just go through and read the news items from there as well. But for the market as a whole, I, I guess CNBC, Wall Street Journal. I mean, The Economist. I like to read that. Um, so I try to get a diverse set of New York Times. Try to get a diverse set of news information flowing my way.
That's great. And I just first of all, I want to thank you so much, John, for your presentation. I know we have a lot of actually comments that came in that said thank you so much for taking the time, and it was a great presentation. Especially people who had seen all the other portfolios, they were really happy that they ended on a high note with SSR. So I just want to thank you, and then also I wanted to ask you if you had any last comments before we wrap up our presentation today.
No, I just want to thank everybody who is involved with the association. I mean, you as members, Jenna, you as an employee. I mean, our goal is simple: is to discover what individual investors can do, what they should do to meet their financial desires and dreams. And with these portfolios, whether they're SSR, whether they're an index fund, whatever works for your level of involvement that you want, we want to give you the information you need, educational resources you need to meet those goals. I mean, too often, I think we all have the ability to make intelligent decisions, and I think the difficulty with investing and being successful long term is discipline and being able to find an approach that makes sense, that you believe in, that you could stick with in good times and bad. And again, it's if SSR is for you if you want to manage a portfolio of individual stocks. If you don't have the time for that, then you're probably better off investing in index funds, low-cost index funds, and rebalance your portfolio periodically. So, for some of us, it's a hobby, and it's a way to learn about the economy and apply some specific knowledge that we have, and it's a great exercise. Now, over the years, I've had the great pleasure of reading the books of many of these gurus, and writing an article for the journal, trying to get into the mind of what they were thinking and coming up with quantitative rules that help find the kinds of stocks that Warren Buffett would want to invest in, or William O'Neill, or John Neff, or David Dreaman. So for me, it's been a great way to expand my knowledge, and um, you learn a lot by trying to teach things and trying to explain them to others. So I thank you as a member for giving me the opportunity to better myself by trying to teach you guys a little bit about the investing process. So thank you for your support, and thank you so much for your membership.
Yes, thank you so much. And honestly, that was a great presentation. I want to say thank you so much for, guiding us through the SSR portfolio, taking us back, looking at 2023, and then also giving us some, greater insights on, the strategies and breaking them up. I think that really helps a lot of people who are just like, they're just getting into it, or they're not sure where to start. So that was fantastic.
Well, thank you, Jen. And
And
again, thanks so much for your effort of shepherding us all week.
yeah, of course. And I just want to mention that, obviously today was our final event of the Model Portfolio Review Week. So, each day this week we hosted subscriber only events at, at 2 p.m. Central each day. We started off, the week with the shadow stock, and we are ending it with SSR. If you missed any of them and would like to tune in, if you're an AAII Platinum subscriber, you'll get access to every single event that we hosted this week. You'll just basically go to any of the premium product subscription websites. So for example, today was, ssr.aaii.com, and you can view the on-demand version anytime. I think we will make it available early next week, but it'll be under the how-to and then the videos tab. I linked it in the chat a couple times, but I will also include it on the links and resources document that we make available early next week as well. And we also, if you aren't an AAI Platinum subscriber but would like to still view the on demand, we're still running our, our $1 for 30-day trial, which includes the on demand access to the recording. So I linked it in the chat, but then if you want to visit, it's invest.aaii.com/AAII-flash-sale. And if you like I mentioned before, if you have any questions about the SSR portfolio or the strategy, you can feel free to email johnb@aaii.com. And then if you have membership, questions, cost, pricing, anything like that, technical issues, feel free to email us at members@aaii.com, and our member services team will be happy to help. And if you haven't delved into the SSR portfolio yet and want to, like I said, you can visit ssr.aaii.com, and there you just can discover strategies from the various gurus that John went through, O'Neill, Dremen, O'Shaughnessy, Neff, and then view SSR's portfolio performance. You can read the weekly commentary, check out the monthly insights, and as well, we have a pretty robust how-to section if you're just getting started. And just because we saw a couple questions come in throughout the presentation, I always like to mention again that this presentation is recorded, and a replay of the webinar will be available early next week on the SSR website, along with links to this presentation's handouts and any resources that we discussed today. So with that, I want to wish everybody viewing good health, good fortune, and a great rest of your day. Thank you and take care.
Take care. Thanks, everybody.